Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, August 18th, 2023. S&P 500 currently sitting at 43.63. I'm here with Ian Connor Shaw McMillan. It's been a while, Ian. Where have you been? What have you been up to?
It has been a while. It's good to be back.
It's great to have you back.
Yeah.
I assume you have a good excuse.
I do. I had our second baby boy. So that was,
Congratulations.
I guess, it'll be three weeks ago tomorrow.
Okay.
Yeah. So everything going great. Very healthy. Everything went about as smoothly as it could go. So
I love it.
of course, very grateful for that.
Yep. Congratulations to you and Kate. While you were gone, market started to correct a little bit. I started to blame you for that, but then you're back this week and the market continues to sell off. And I don't want to make it overblown, but I mean, the selling this week is equivalent to something we haven't seen on a weekly basis since March of this year. But where would you like to start as far as things we want to highlight for our listeners?
Yeah. So I guess it'll be our third weekly candle, most likely. I don't think anything, at least at the major index level, has been broken yet. You know, this is obviously coming off a pretty strong rally, not just from the October lows. It was a 32% rally. Even from the breakout above 41.80, I think it was 10 or 11-ish, like 10-ish percent from 41.80.
Late May, we almost got to 10% on that move from late May into the end of July.
Yeah.
So in 2 months, about 10%. And last week on the podcast, I was a wolf pack of one. I played a clip from our previous episode together on how pullbacks are perfectly normal.
Mm-hmm.
And here we are 5% later from the end of July, and August has been nothing but down.
And we talked a lot about the Q4 2021 necklines. S&P got there. NASDAQ also got to its neckline around 15,900. I'm going to call it 15,700, 6,700. Tried to get above. We're back below the late March, April 2022 highs for the NASDAQ at 15,200-ish, 15,300-ish. So we'll see. But certainly nothing broken. Now we got pretty extended from some 200-day moving averages.
Right.
So eventually, not saying it has to be now, but eventually we'll most likely need to catch up to those, whether that's down or sideways. TBD. I think you made a pretty good point that about roughly 200 days ago, you'd said this in one of our team chats, 200 days ago was the October lows. It's not perfect.
Right. I mean, it's close.
But we're getting to the point where, the S&P 200-day moving average has been turning up and losing that data. Kind of the lowest of the worst, right? We're losing some of the worst numbers over the last 200 days.
Yeah, correct.
You look dropping off here.
You look back 200 trading days. It's October 31st of 2022, that mid-October bottom that we now know is an important bottom. You look at that data starts to drop off. And for those listeners who might not be familiar with the moving average, you're just taking the prior 200 days of information, imagine stacking it up on an Excel spreadsheet and then averaging it out. And Ian's point is the backside, that data from October, November of 22 is going to start to drop off, which causes the moving average to actually accelerate upwards, which is a quality characteristic as far as the combination of this pullback, this 5% pullback, and a 200-day moving average accelerating up, that allows things to, I'm not going to use the right term, but like normalize. We were pretty far away from a 200-day moving average previously. Something like the S&P 500, we talk about the end of July, was about 12% away from its 200-day moving average.
Yeah.
And when you look back historically, that tends to be a statistically significant area where the S&P likes to pause. And now we're at a situation where the S&P 500 is approximately 5% away from a 200-day moving average. Perfectly normal market behavior. But otherwise, we should also recognize that overhead supply, it's very apparent.
It is.
Where it showed up. We'll use S&P 500, that 45.95, the 4,600 level. There's supply there. And so we need to work through that. When we look back, or in past years at August and September, they're notorious for weakness. You look, whether it's August, September of 2020, John, the S&P 500 of 11%, or 2019, where you have a range about 7%. There's plenty of examples going in the past where August and September are just notoriously weak and have a range, and that's markets, baby.
Yeah, and you've got some, two of the charts, for better or for worse, that I tend to keep an eye on. Not because I'm an NPC, because they just have an impact. Our Apple and Microsoft continue, right? And clients we talk about those from time to time in the newsletter. A little disappointed, did not hold Apple, did not hold 180, 183, whatever you want to call this up here.
Yep.
We are also now below the August 22 highs on Apple. We'll see how that turns out. And then same with Microsoft, did not hold 345. Kind of coming into a place where I could see it finding some support, though. It's still a bit from its August 2022. It's amazing how different these charts they've ended up in the same place, breaking the new all-time highs over back in July. But very different Q3 to Q4 of last year from these two. I could say that now Microsoft's holding up better than Apple.
Yeah.
So I guess that's kind of what I'm getting at.
Yeah, no, that's a fair. And if you're a technician and you look at that relationship, Microsoft versus Apple, that's something that's building a base going back to January 22. Is this an environment where we see?
Yeah, wouldn't that be something? So yeah, look, Microsoft has outperformed off the lows back in October.
Yes, correct. That's a great observation.
About 20%.
And when we look at markets from a supply and demand perspective, as technicians and experts who deal with supply and demand and operate in this environment, obviously it's always easiest when something breaks to a new high and then just follows through and continues to move higher. But there's also environments where there's a retest. So you come back. And so is this a retest in Apple at the 170 level, 175? But there's also environments where, and I could use gold as an example, when you look at gold and look back to its high in 2011, we've been wrapping around that high. So above it, then back below it, then back above it, then back below it since 2020. So going on 3 years, the high from 2011, we've wrapped around that high, and that happens as well. Like, these things could turn into false breakouts. I'm not here to say that they aren't. And a false breakout is simply meaning that Apple would continue lower from here and not look back. That July high was, a sayonara high, which no one would.
Imagine looking at that chart in a few years.
Right.
Because, that's the type of action where you would look back.
Yeah.
It's not, go to a month. I know we got 12 days left. Calendar days, or I don't know how many days are in August. 30, right?
Right, 31.
We have 30. that how that little song goes?
Yeah, 30 days has September, April, May, and November. All the rest have 31 except for February. I could be butchering that. I could get them all wrong, but I know August has 31. And I think your point is you're saying we're not that far off from a monthly recording. And what does Apple look like?
I mean, Apple's given back the last 3 monthly candles almost.
Yeah, I mean, that's...
And is that something where you would look back on in a few months, a year or two, and say, oh, yeah, look at that monthly failed breakout?
Yeah, I mean, and then you look at something like semiconductors, which, I mean, you look at it on a weekly, you look at it on a monthly. This is what double tops are made of.
Yeah. Yeah.
Now we have to wait. Like, there's no way we know that now. But you look at semiconductors using something like SMH, using a weekly time frame, there is supply in the 155 to 160 area that goes back to 21, 22.
For sure.
And we have to work through that supply. That's just demand supply dynamics. Let's not overcomplicate things, right? More supply than demand, price drops, more demand than supply, price rises. Semiconductors right here, it makes sense that we're seeing some supply and resistance. Now, does this turn into a double top in semiconductors? If it does, that would be incredible information a year from now. If semiconductors move lower, that would be time frame wise, like years to decades type correction underway. And that's pretty hyperbolic talk. I don't want to come across as super bearish, but you have to pay attention to some of these things. You know, you talked about Apple build breakout potential. I'm not saying it is.
Dave's so bearish, going to go build a den in the woods this weekend.
You just
start hibernating.
You getting off the grid? That's funny.
Start eating honey.
Oh man,
isn't that what Winnie the Pooh ate?
Oh, I'm sure he did. I don't know if he should wear his outfit though.
Yeah, yeah, you can never have a card. Well,
you can't just be wearing a t-shirt around town. Completely inappropriate, Winnie.
Winnie the Pooh. Well, I'm not going to ask that. This is not a podcast for that question, but.
All right. Do we have a dress code? Yeah, we got a dress code.
We have a dress code.
But going back to, could this be a double top in semiconductors? That's way too soon. We have plenty of information from other areas of the market or other charts that you look at where you could see price wrap around prior, which had been a leader out of this. It's sitting in this area that goes back to 22 and 21. It makes sense that we would digest in here potentially, but NASDAQ could also head all the way down to 330, the August of 22 highs, and move around from there.
Man. Oh, China gave up its whole move.
Yes.
Ugh.
China is so interesting because, you know, it was one of those leaders off the bottom, and here it is negative 15% year to date.
Vietnam finally got slapped. I know we don't spend a lot of time talking about Vietnamese equities.
That's an interesting one.
They had been strong. I don't know why. Yeah, interesting. And then the old, I don't know, is this still going on? I had seen the old Twitter sphere last night that Bitcoin was getting hit. Yeah, look at that. And look at that. Right into those, it never cleared those anchored VWAPs from the highs, from the November 2021 highs. We got there in April of this year. We got here in like June, July. I mean, we got there. There was pretty good setup. I mean, you look at mid-July, you had to be pretty happy with Bitcoin.
And now we're here reversing lower.
Now here we are at 26,000.
It looks like we have a visit with 24,900 upcoming.
Yeah.
And that's that. I mean, I don't know what the future for Bitcoin is, but right now, I mean, and if you broke below 25,000 on Bitcoin, you now have to consider the thesis that the November 22 through July 23 move was counter trend in nature.
Yeah, that would be right. I mean, and you got a pretty big, I mean, there's a pretty big divergence here on Bitcoin, daily RSI you're back to, I mean, Bitcoin gets, when you lose, I probably wouldn't use a 14 period RSI on Bitcoin now that I look at it, because this thing gets quote unquote overbought and oversold with every rally or correction.
Right.
So you might want to find like a different time frame from that. But using the 14 period, pretty big divergence this year, going back to the first big rally in January. Counter trend, never cleared that 31. What is that, like 30? You pull up a long-term chart, that 30 to 31,000, 32,000. That's a big.
Right. Bitcoin still either A, in a counter trend move, or B, trying to base out before moving higher. International stocks, you mentioned China. I mean, there are other areas that have held up okay. We've talked about Argentina on here before. Does that hold? Every spot is different in this environment, and that's notable.
Yeah, we're going back to one of Dave's favorite sayings: each chart on its own merit, right?
Yeah, man. Each chart on its own. Yeah, for sure. I learned that from Peter Brandt, and that's information from the standpoint of international stocks do well when the majority of the international pieces are doing well. And that's not the case right now. It's very bifurcated. It's very, for every China, there's an Argentina. And so there's this massive dispersion between different areas internationally that you can't just say, oh yeah, international's good. It's not. You can't just paint a broad brush. There's some spots that are holding up well, some spots that are not. And it's worth paying attention to in the trade weighted dollar strength that we've seen since, wouldn't you know it, the end of July. Yeah. So we've seen dollar strength since the end of July, equity weakness. And there's some international areas that have really suffered from the dollar strength. I love it. You have to take each chart on its own merit. So we've had a nice pullback here, 5%. You highlighted a really important area on the New York Stock Exchange Composite a few episodes ago at the 16,000 level. We've broken below that.
No, say it isn't so.
Yeah.
It is so.
Yeah.
Yeah, so much. I mean, Bulls had it in the palm of their hand.
It's definitely one of those environments that strikes you for liquidity, starving for liquidity. That price moves above important areas, then pulls back in and does this whipsaw action to pull in buyers and sellers. That definitely has that feel when you look at, I guess a stock that you could look at is something like IPG, Interpublic Group of Companies.
We used makes that, didn't we? And then the ETF for a bit.
Yep, broke above an important level.
Oh my gosh!
Yeah, like full sellout. Like
it. Juicy chart going into mid July, man.
Right. So you have some things happening where there's, for our listeners, a breakout is when you get above a certain level that had been supply previously, and supply could have been there for 6 months. It could have been there for 6 years, but there's an important level where sellers have shown up. You break above that level. There's certain times where that then moves higher. Price moves higher because there's no longer supply. Demand is in control. But when we look at some of these things, false breakouts are apparent. They're around. Like you even use an ETF like BOUT, which is a breakout opportunities ETF, trying to track breakouts, buy breakouts. The irony being that in something like that, you continue to see false breakouts. And so that's the environment we're in. We reclaim a level, then pull back in, reclaim a level, then pull back in. So it's not an easy market when you look broadly.
It's like coming out of 87.
Yeah.
Go look at that market coming out of 87 for you listeners at home.
And 87 is notorious for October of 87.
It is.
But are you talking about like late 86, early?
The rebound out of 87.
Yeah. Oh, yeah. Right.
I just think as a, right, and this is as a trend follower, clearly lots of paths to go down. But as far as the start and then the stop. And then you get going, and then you're back in the right-hand lane, going 45 in a blizzard. And then you're in the left-hand lane going 85 down the California coast. And then it's just, right?
I see your 87, and I raise you 91 to 94. 1991 to 1994.
Yeah. Yeah.
It's not a pretty trend. That could be an environment that we're currently heading into.
I could see. I always tell my dad that I joke around that I hope at some point in my career I get my 1990s environment. So
1990s was incredible. And then you go study it and you're like, okay, we can talk about 94.
I want that before my kids go to college.
Right.
So a nice bull run into decade long and not a 20% correction every 18 months like we've had for the last 5 years.
Right. Yep. And at the same time, perfectly normal market behavior to have a 5% pullback after a breakout. Now, all that is null and void. If we're back below, I'm going to say the number. I can't believe I'm saying this.
No, then don't. I know what you're going to talk about.
If we're back below 4180 in the S&P, we got problems.
Well, and that's where the 200, I think that there's a possibility that we're on track for an inflection point of 4180 in the 200-day moving average.
Oh, sure. I get what you're saying. Like the 200-day moving average is coming up into 4180.
We're talking about early, mid-ish September.
Mm-hmm. Yeah, we're visiting that in September. It's a 200-day. It's an important horizontal level. That confluence.
I'm probably renting like 3 trucks, backing them up if we get there.
Oh, yeah. You're saying it's time.
Yeah, and then also here, check this out. Not only there's a rate of trend there.
Yes. I know. Yes, I know exactly what you're talking about. Right.
It's a rate. There's potentially, if we get there, I'm not saying we do, but you've got a massive confluence of
rate of trend, 200-day and a horizontal level.
And a super important horizontal level.
And the beauty of that is Ian's not saying, I love that you say back up the truck. His point is it's not a guarantee. That's not what he's saying. He's saying it's a low risk.
Yeah. Now I could be all that back 3 days after. I could say, hey guys, you can bring those trucks back, and I got to get rid of this. Right.
But you have a well-defined area of risk. And that's really what risk management is about, is if we're back in the 4180 area with a 200-day horizontal level rate of trend, that's a really good spot. You might be risking 1% to 2% with the opportunity of multiples higher, but at least you have well-defined risk. And if you're below that level, we got issues, and that's okay.
Chasing was going on. I had a couple, I guess, somewhat facetious tweets back in late June. I can't remember. I'll have to go pull it up. Maybe the first week of July. So, we talked about there is, and since you brought it up, the jinx has been broken. Now it's out there. It's been manifested. But so 4180. Ad nauseum, clients probably stopped even reading newsletters or listening to the podcast. So we talked about 4180. How much chasing was going on those first 2 weeks of July? Everything at that point had lined up. Right. You had what you had talked about, the New York NYSE composite. Finally, right, from a behavioral standpoint, all the boxes had been checked. Or from a behaviorally technical standpoint, all the boxes had been checked. And now we've wiped all that out. I think it'd be 4180 yet again as another reset. Could be logical. We talked about this earlier. We're also back at the August 2022 highs.
Right.
Which I think is also in pretty logical. Yeah, this might be one of these reps where you don't get to revisit, right? Maybe you don't get your 2010, 2011 where you get to revisit the 200-day and reset, and it kind of figures itself out for 9-12 months.
Right. Well, the 4,300 area is important.
96?
Your 4,300 area is important. I mean, that's where it's an area of polarity. You brought up August of last year, but it's also an important area from January of 22 and September of 21.
Yeah.
This area we're heading into, this 4,300, 4,330, we may not touch 4,180, but we could still be in healthy pullback.
Yeah.
And this goes back into seasonality, right? August and September.
Yeah.
We look at every year, historically weak. You head into October and November, December, we start to see some strength. Does that happen this year? To be determined. I think like it's really a if this then that scenario. If we're above 4,300, if we're above 4,180 heading into October, that's a healthy environment. If we're heading into October, a notoriously important month for the market, and we're below 4,180, there may be some things going on in the market that most aren't expecting.
We get into late September, October, and we're below 4,180.
That's an issue.
That's like we've got, because at that point you're also probably below a 200 day.
Right.
Most likely. I mean, it can
Right.
play out and, I don't know what happens over the next month and a half. But based on current rates of trend, yeah, you're back below 10. And yeah, we did get there in 2010. I mean, that got pretty wonky there. 2010, 2000, and then again in what was that, like Q4 2011 was kind of weird.
Right. And I guess I would highlight at this time, this pullback that we've seen of about 5% in something like the S&P 500, which is pulling the NYA, New York Stock Exchange Composite, below 16,000, is coincident and maybe shouldn't be discounted with treasuries, 20-plus year treasuries breaking below important levels.
Yeah, how about that? Clients, when you get your newsletter next week, we'll have something to say about treasuries finally.
Right.
We'll update the little chart with the range, and it will have broken below.
It would have broken below, and that signifies higher rates. That signifies the 60-40 portfolio and its demise. If we're breaking below TLT, using TLT, that's an ETF that represents 20-plus year treasuries. If we're breaking below 92 on that instrument, or you look at aggregate bonds using AGG, and we're below 93, we're not there yet on AGG.
That's nasty.
But we're definitely in an environment where the 60 portfolio, and is this sentiment? I'm about to say the 60 portfolio.
I'm not there to collect. I don't care how big the yield. I'm not there to collect 4% yield and lose 7-8% of my capital.
Mm-hmm.
I think we could go through a generation where so we've talked about this, right, Dave? We've talked about the potential change coming. We've talked the trend lines. When you look at yields, the 30-40 year trend lines been broken, and we know from history, hundreds of years of history, that interest rate cycles move in 30 to 40 year periods.
Yep.
And we've talked about that there is a pretty decent potential. I still hold really true to this, that all the relationships that have been built up in this industry over the last few decades get tossed out the window.
Everything from the early 80s gets tossed out.
Yeah, like, when X happens, this happens, or this type of relationship, lumber versus gold means something, like whatever it is. There's so much. I'm not saying any of it was bad. I'm just saying, or that any of it had a lot of practicality for a long time.
It did.
I just think you've got to be open to it. And could this be potential where you can now have entire generations? I guess most likely this would be as Gen Z comes into their higher earning years and where they actually are like, wow, I need to kind of build an investment portfolio for myself, or I need to meet with an advisor, whatever it is. And bonds just aren't, I'm not going to say they're not talked about, but there's just this lack of, do they just not have a practical use? Maybe they still cut down on overall volatility, right? I get that from a beta standpoint.
Right.
They'll probably stay less volatile than equity markets. But if we are looking at, this sounds absurd, but this is data. If we are potentially looking at 3 to 4 decades of higher interest rates, let's say even, okay, bet 2 to 3 decades. What are you doing with bond? I mean, I'll tell you what, Dave, over the next 2 to 3 decades, I'm trying to retire. And I think you are too.
Mm-hmm.
And I think a lot of people out there are in the same. So what role do bonds even play? Are they even a thing that we talk about seriously as a real allocation in the next 10 to 20 years? I know that's really like far out.
I get it because, I mean, your point is just, if I'm going to own 5% yield, but the instrument that gets me 5% yield is dropping 7%, I'm now negative. You could buy the instrument straight up. You could buy the treasury, like not using TLT. You could buy the instrument and hold it for 30 years. But if you're in an environment,
you get a great yield.
Yes, you get a great yield. And at the same time, not outpace inflation or not outpace the opportunity cost gets you because the market's moving in a certain way. But the risk parity trade, which is a really fancy way for listeners who are out there that might be like, what is he talking about? Risk parity is just a fancy way of saying when stocks are weak, bonds are strong. When stocks are strong, bonds tend to be fine or weak.
Yeah, they're kind of fine and people are interested in them, but they definitely
right. They don't hurt you.
Yeah.
The risk parity trade being over, which is bonds no longer buoy.
2022, basically.
Right. Yeah. Like don't hold up your portfolio as a retiree is significant. That's a significant change. And that could be the environment we're in. Now we're talking about this at an extremely important level on something like TLT or 20 plus year treasuries around 93. We could rebound from here, no problem. But the information that we have currently is those bonds are in a downtrend. Rates are in an uptrend.
They are. And we know there's the high probability we've come to the end of a cycle.
Right. Yeah, if you were going to paint the picture of what does the end of a 30 to 45 year cycle and rates look like, that COVID move definitely.
The angst we've seen from, look at mortgage rates. So highest, I think we're at somewhere a little over 7% as your national mortgage rate. And all the angst that is, and so that's the highest since 2002. I saw yesterday. Highest national average mortgage rate since 2002.
Yeah, that's legit.
Yeah, and how, just I don't think, and to me, in the back of my mind, again, historically, is it a lot more than the 2 3/4, 3% that people were getting 3 years ago? It is. But historically,
it's been higher.
Yeah, it's how much we view the behavior of how we've gotten used to this
low rate environment.
Yeah.
And really, like, barrel of oil is the same thing. Like your average barrel of oil going back hundreds of years is between $20 and $25.
It's like inflation adjusted.
Right. Does that continue? Could continue. Interest rates, you're at an environment where it appears that you can now build a home and actually get a return immediately for the raw materials that you put into that new home versus the opportunity cost of buying an existing home.
Yeah.
Which is that's not an environment that we've seen for a long time. You know, typically if you bought a home or you built a home, it took you multiple years, if not a decade, to recoup the opportunity cost of buying the raw materials. And so now we appear to be in a different environment where your home construction has more opportunity than existing construction. And that's one of those dynamics, going back to your main point, that relationships change when your major cycles in interest rate change, which also could impact, like, when you look at stocks overall, what they represent. Do some of these more international conglomerates have an advantage because they can play the interest rate game? And what I mean by that is they can manage their internal cash flow across countries and their interest rates, and that helps them. So this is an era of the Nifty 50 again, a new Nifty 50. So like you think about the 40s, 50s, and 60s, there was a Nifty 50. I'm not talking about the India Nifty 50 that we now know. I'm talking about 40s, 50s, and 60s. You had 50 stocks, very large international conglomerates that were the leaders for 20 years because they could manage the interest rate cycle during that period. We could be in that. We could be in that period. Time will tell. When you look at small caps versus S&P, it's at a pivotal level. So we covered a wide variety of areas. What about the premium paid for optionality? So like the VIX, something that measures the volatility of the market. Where are we at in something like that?
VIX. We are for the 200-day. I mean, we're above 15.
And I would say, there's many people that would say that you can't use technical analysis on the VIX. But if you look at the rate of trend of the VIX, which is a S&P 500 volatility instrument, since Volmageddon, which is January of 2018, and the rate of trend that's taken place since then, we are now kissing the underside of that rate of trend in something like volatility.
We are.
So time will tell on whether we continue to see increased volatility. There's also a thesis that's in play of the third and fourth quarter of 2022. Everybody and their grandmother knew that the market was heading lower. We now know that it didn't. But the short positioning, the protection, or the bet that the market was going lower was so high during that period of time. Did we just see a complete wipeout of the shorts from that period through July? And that's where things get dangerous, because you've cleared out all those bets to the downside, which are once the market moves against them.
Mm-hmm.
That now we do see 4180 broken because nobody's willing to take the short side anymore because they got burned so bad. That's also a thesis that's still alive.
Yeah, I mean, I would also say along the same line of thought, we don't need to go into a ton of detail, but, we've talked about over here, and I think that there's somewhat of validity to it in the ETF space when certain ETFs close.
Sure.
Or coal, shipping.
Right.
Certainly there's been some 2 and 3x themes out there where Direction or some other fund companies closed their leveraged products
at just the right time.
We saw a fund that was very, very, an actively managed fund that was very, very bearish since it has debuted, and it is closing its doors. And I wonder if there's a potential for that to fall along the same lines of have the truly, really outspoken bears, those people that are betting really heavily against the market the last 6-9 months. Have they been, mentally and emotionally wiped out? And what do we see? I'm not saying that leads to new lows, but is there some type of pause? I guess. Whatever it takes.
Right. If we were to near-term bottom at these levels and create a 5% range heading into October, November, that would be perfectly normal. And this is happening in an environment that you're talking about where we cleared out all the shorts that happened last year, right? Because it was I'm talking facetiously, it was so obvious that we were going to have a market collapse and a major recession, that everybody, and apologies to all the grandmas because you're wonderful, but everybody and grandma got short and now they're cleared out. Typically when that happens, you have a little bit of a reset, or that's when things get really exciting to the downside. And that's not what I'm calling for. As market historians, when we look at, like, for example, 2008, 2007, 2008, the move from like March of 08 into May of 08, we were out of the woods, man. Like, things were good. Well, it was just the shorts getting cleared, and then we move lower. Mm-hmm. Is that environment we're in? I don't know. I'm not here to tell you what it is. We only know that below 4,300 and below 4,180.
Yeah.
But your point is extremely valid that there's an ETF that was short focused that's closing its doors in a very short amount of time. Is that actually the anti-sentiment? Is that the opposite situation? Time will tell. And speaking of time will tell, we're almost up against our time. Anything you want to cover before we wrap this up?
No, yeah, I think we're just in wait and see mode. I know that's not super sexy to say. Been a good rally based on historical levels, got pretty extended. Certainly down, like I said earlier in the podcast, I don't think anything's been broken or anything's bad. It's just a correction, right? When we've got an upward sloping 200-day, that should only get stronger. That should only start sloping up even at a higher rate, to be honest.
Absolutely. Counter trend moves within trends happen all the time. If there's something bigger on the horizon and the market's going to correct in a bigger fashion, we'll know that by simply using math. Clients will be familiar if we're below 4,300, if we're below 4,180, if we're below a 200-day moving average. There's certain things that happen. But above that, this environment that we've seen since the beginning of August is perfectly normal. We could see some stabilization here. We don't know. We always use price to confirm or deny thesis. And right now, as Ian said, uptrend intact, perfectly normal pullback. We'll see what happens forward from here. But I can tell you, Ian, that I'm looking forward to our listeners giving us a high ranking, sharing this with their friends. I love that this episode is supported by the Adaptive Select ETF, which is listed on the NYSE under ticker ADPV. This ETF helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. With that, Ian, we've reached the end of our time. One last call. Anything else you want to highlight before we wrap it up?
No, just want to wish everyone a good weekend as the summer continues to draw to a near. Probably lots of kiddos getting ready for school out there.
Mm-hmm.
So
two of mine are in school.
Yeah, best of luck. Best of luck to everyone going back. I say that to children and parents.
Yep. And across the country, probably lots of Friday night lights firing up tonight.
Football going on tonight. I'm going to have to find a way in this week or next to try and go find something locally to watch.
Yep. So my nephew, Simdog, Simeon Zarling, Big Diesel, senior year tonight. Amazing lineman, both offensively and defensively. He plays tonight. Excited to watch him. But I'm sure across the country, lots of Friday football happening. And that's always an exciting time for young adults across the country. So that's exciting. Ian, great to have you back on. Excited for you and Kate and your new family addition. Thanks for joining me.
Yep. Have a great weekend, everyone.